You're listening to The Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert Tina Mitchell right here on 1150 AM KKNW, the Saturday, April 8th show, bringing in expert advice and inside knowledge on today's events in our local economy and how they can affect your money. If you're hearing my show at a different time or day, you are listening to a rebroadcast. You can call the show at 1-855-400-1150. Again, that's 1-855-400-1150, or go online to themoneyhour.com to discuss anything regarding money or talk with the guests that I have on the show today. And right now, conversation with Scott Schaaf with SW Group Credit Repair. And we're going to be talking about credit repair and credit miss. Scott, thanks you so much for not joining me in studio because you're a little ways away, but having a chat with me over the phone. I appreciate it.
It's always great to be back on again, Tina.
And a little bit about Scott. Scott is a nationally recognized credit expert and the president of SW Group, a private referral-based credit repair organization that works with lending banks across the country, including myself, to assist consumers that have some credit challenges. And so I'm excited about our conversation and talking about credit repair, also talking about credit miss. Always fun to hear what the myths are and to give some clarification on that. So let's just start out, Scott, if you can share with my listeners, what is SW Group?
Yes, SW Group is a credit repair organization, and there are lots of credit repair companies that are out there. We're a private referral-based credit repair organization. Basically, we work with banks across the country and primarily deal with people that are interested in purchasing a home, and they're not able to get approved because they have questionable negative items that are on their credit reports, such as collections, judgments, tax liens, bankruptcies, things that are on their credit report that are holding them back. And using federal law, the Fair Credit Reporting Act, Fair Debt Collection Practice Act, Fair Credit Billing Act, there's a bunch out there. In a lot of cases, we're able to dispute those negative items and have them removed from the credit report.
So if my listeners don't have the credit score that they're wanting, they're applying for a mortgage or they're trying to get a car loan or anything else that they're trying to do, maybe get a job because employers are looking at credit as well, what can a consumer do right now to help their credit scores?
Great question. Everybody that's listening has a credit report and score that's out there. If they were to pull it, they're going to have something that's going to report, whether they're going to a local store to apply for a store card, a home, a car. What can you do to help your credit score? And there's a lot of just lack of knowledge out there. So the best thing you can do is pay down your balances on your credit cards. That's the most actionable method that you can do. And the magic number is 30%. Mm-hmm. So if you have, and it's all of your credit cards combined, there's what's called a utilization ratio. And that is where you add up all of your credit cards and your total limits versus what your balances are. And if it's above 30%, Tina, unfortunately, that's going to harm your credit score. And a lot of people don't know that. So you want to make sure always keep your balances down low to help your credit. And if it's high on one credit card, but all the rest of yours are at zero balance, that's okay. It's the overall total of the limits versus the balances.
And I think that's good to mention, Scott, because that could be a myth in that it's not per individual credit card, but add them all up. So if there's an opportunity for you to pay down, it makes more sense for the other one. Get that overall revolving debt to that 30.
You might have a 0% interest promotional rate, and you want to switch all your balances over to that card. That's fine. And a lot of people think, well, I spent a lot of my credit cards and I paid on time, so my credit must be good. And they don't know that, yes, paying on time is a big portion. I mean, paying on time and your balances are like 65% of your scores.
Yes.
So, yes, paying on time is always important, but they don't know that if your balances are high above that 30%, it's going to negatively affect you. And bringing those balances down below 30% will dramatically increase your credit in a lot of cases.
Any other quick tip to increasing credit? Yeah, I was. Yep, I was. A big mistake that you can't recover from is closing down those counts. Any other quick things that you can do for increasing your credit scores?
Well, just to go back briefly on the closing of accounts, I hear this a lot. People say, well, I have this Discover card with $5,000, $10,000 limit, and I never use it. they think if they close it, it's going to help their credit because they don't need it. And that is the absolute opposite.
Yes.
It will help your utilization ratio. Keep it open. You don't have to use it. I recommend fill up a tank of gas. If you don't need to use it sparingly, pay it, just show a little activity on it. And then you will get offers for increasing your limits more and more. You don't need to use it.
Yes.
But it's good to have it as a tool in case you need it in the future.
Yep. So, Scott, what is the difference between credit repair versus debt consolidation? Can you share that? Because completely different.
Yes. Credit repair and debt consolidation are two completely separate things. When people get into a situation where they have bad credit, they have collection accounts, they have public records, perhaps maybe judgments or taxing, they can go three different ways, really. One, they can do nothing, which obviously you don't want to do. But now, number two, you could go to a debt consolidation company. And what that is going to a company where they will get all of your debt and they will get down to one payment with a company, but that's going to negatively affect your score. It's going to reset the statute of limitations on the accounts. Every situation is a little bit unique. However, a lot of times we catch collection companies in violation of federal law. They don't have the necessary paperwork. Credit repair is having the items just permanently removed from the credit report. With debt consolidation, the item is still there. It just shows as a paid collection, which if you come to us after that, we're still going to go after a paid collection because it's still showing as a collection. And unfortunately, a lot of times paying the debt, it just switches it from a collection to a paid collection, and that still negatively affects you. It's the fact that you allowed it to go into a collection status in the first place that it negatively affects you. That's why it's best to just have it removed from the report if possible.
Yeah, so what if you do credit repair? So, listener calls you for credit repair. You go through that process of anything that's in violation of how it's getting reported. That's how those get deleted. And then with the remaining items, if it makes sense, you go do your debt consolidation on that. And then you come back and get the credit repair from the debt consolidation because there might be more violations. Could that strategy work?
Yeah, every report is a little bit unique, but if we exhaust every single aspect possible and it's still not being removed, then there's a good approach, which is doing it settle and delete, which is where you agree to settle and they agree to remove it from your credit report as well. But that's a rare instance. In a lot of cases, we're pretty effective, but it does happen occasionally. But that is a backup, for the very end of the credit repair process, because otherwise you basically avoid paying a lot of collections and having a refresh of the statute of limitations on your credit report for another 7 years. It's best to try to get whatever you can off your report, and then whatever, just no matter what you can't get off, then deal with it at that point.
Yes.
In that aspect.
So, Scott, can you share the difference between SW Group different versus other credit repair organizations in the industry?
Yes. There's a lot out there. Popular ones like, I'm sure everyone's heard of Lexington Law and other big companies like that. When you call a major company like that, what they do is they charge you a low monthly fee to just drag out the billing process and the credit repair process. You speak to somebody different every single time you call. They are just reading a script off a computer. And I can't say every single representative there, but for the most part, they just look at you as a random person on the phone, and there's no real motivation for them to actually care or even know who you are. With SW Group, you have a personal contact here that knows exactly who you are, and if you were referred in from a mortgage broker, they know exactly who the mortgage broker is. We're in communication with the mortgage broker, and we have a much more comprehensive approach, and the results and the amount of effort and time that's put in is night and day compared with a lot of other companies out there. But there are other private companies that do a good job. But if you go to one of those mainstream ones that are massive, you're going to get much less service than you will with us.
So, Scott, I want to switch over to Miss, and first one I want to ask about is collection accounts. And I always advise clients that they need to talk to an expert to find out exactly what to do and when to do it, because it can be devastating. We already talked about it with closing revolving credit cards that you're not using. It could be very damaging if you go close out accounts that have a history. What about collections? Because there are times you don't want to close out a collection either because of that same reason of closing out credit cards. cards, and instead you want to wait and have that addressed and taken care of at closing. Can you shed on that myth why that is?
As far as which collection, run that by me one more time. I want to make sure I understand.
Yeah, so is not. We know that a portion of your credit scores is the pie chart is based on the history of that actual account and how long you've had that account, and that's why when you're stating not to pay off revolving credit, to close down revolving credit cards, because if you do, you've lost that history on that account. So and you can't get it back if you've got an account that you've had for 10 years and you close down that credit card. Now you've lost that history for that 10-year period. So on collections and paying collections off, instead of just having them taken care of at closing, once you pay those collections off, a lot of times that you've lost the history for that account once that collection has been paid off. Can you, what's your comment on that?
Right, yeah, the account history is 15% of your credit score, which is important, obviously, but it depends on every collection account. Obviously, every situation is different. It depends on the loan, and that's something that, for example, if you go to another credit repair company, they're not going to be speaking to your loan officer. If you even ask them to do it, they're going to, number one, they're going to have no idea what they're talking about when they call them. So the loan officer is going to instruct us, but if it's a collection account, we want to get it off the report because it's going to negatively affect them more having it on the report than the account history is, because it's going to be negative account history. So it's best to just get it off of there, any collection account. If it's removed from the report, it doesn't exist, and you don't have to worry about paying it to have it removed from your credit report. Now, civilly, that's going to depend on whether they want to come after you for it. More than likely, they don't, and it goes away because the statute of limitations to collect on it civilly goes away in about 4 or 5 years. But going on more to myths, credit reports that you see online, and when you go into a bank, people go to Credit Karma, I'm sure you see this all the time, and they say, wow, I have a 740, and then they go in to buy a home, and you pull the report, and they have a score that's much lower. That's a huge myth that exists. And the reason being is banks pull a different credit report than consumer sites do, and people don't realize that. They think that when they go to a website and they pull their credit report, yes, the items on depending on the site, number one, if you ever go to an online website, you want to make sure that you have all 3 credit bureaus, because a lot of them will maybe only give you 1 or 2, and that's not giving you an accurate reading, because as we all know, you have 3 credit bureaus that are going to be reporting. So you want to have all 3. And your credit scores are going to be different depending on who is pulling the report. Online websites are not the same scores. The information is going to be, as far as the items, is going to be accurate. But when you go into a bank and they pull your actual scores, it's based off of whatever FICO model that bank is using to pull your report.
Yes. So, Scott, I've got a minute left here with you before I'm wrapping up the show. What would be a call to action that you would like to encourage my listeners to take?
Anybody that's listening that has credit, that there's negative items that are on there, collections, judgments, public records, bankruptcies that they would like to have cleared up, all they need to do is call into the show, and we will provide a free consultation, go over everything thoroughly with them. A lot of times they might need to lower their balances, or perhaps they just have a bunch of collections and nothing positive. We can instruct them on how to get approved for positive items to reflect on their credit report that will help to start them to be able to build credit and then eventually be able to get approved for unsecured lines of credit and go from there, and just from then on just have good credit for. But if not, they're just going to sit there with credit dead in the water. It's not going to go anywhere. So it's best to be proactive with it, move past it, and move forward.
Great advice, Scott. Thank you so much. And I appreciate your wealth of information on credit and helping my listeners have a great financial family, because they've got great credit to go along with that, which really just kind of ties into everything.
To be proactive,
yes,
and to not ignore it and ignore the elephant in the room. Be proactive, fix it, move forward, and not have to worry about walking in somewhere about getting approved or not.
Yeah, makes sense. Scott, thank you so much.
Thank you, Tina. Always a pleasure.
And this is your host and mortgage expert, Tina Mitchell, signing off for the day. Everyone enjoy your Saturday and the rest of the weekend. I look forward to speaking with you next Saturday right here at 11:50 a.m. KKNW.